Let's be honest. Markets can be emotional, but when things go up,
I'm so happy.
but when things go down,
Jeez, okay, settle down, everyone.
you panic. Hi, I'm Cecelia with Nelson Wealth Strategies, and today we're breaking down a key investing concept that helps manage risk.
Diversification.
Now, diversification isn't a magic formula or a way to guarantee profit. It's simply a way to bring balance to your portfolio and reduce the impact of markups and markdowns. When we talk about diversification, we're talking about more than just having multiple investments. True diversification is about spreading your money across different types of assets like stocks, bonds, real estate, and cash equivalents, so that no single investment can make or break your financial future. Think of it like a balanced diet. Eating only one food, whether it's pizza, salad, fruit, that might keep you full but won't give your body everything it needs to stay strong. In the same way, putting all your money into just one stock or one business or even one type of investment limits your growth and increase your risk. A mix of different financial food groups keeps your portfolio healthy and more resilient. But here's something more important. Diversification doesn't mean avoiding risk altogether. It means being smart with risk. You're not trying to eliminate risk. That's impossible. Instead, you're spreading it out over so that one investment drops in value, the others can help balance it out. For example, when the stock market goes through a rough patch, bonds or cash reserves may stay steady or even increase. Or if real estate values dip in one area, maybe your retirement account or index funds continue to grow. It's like having a net built from several strong ropes instead of just one thin thread. Another thing to think about, imagine your own bakery. If you sell cupcakes, your bakery is in danger if your cupcakes slow down. But if you also sell bread, pastries, and coffee, one slow product won't put you out of business. Your investments work the same way. So diversification is really about balance, stability, and long-term progress. It helps protect you from sharp downturns while still allowing your money to grow over time. It's not about being scared of risk. It's about being prepared for it. So why does diversification matter so much? Why do financial advisors and investors and even billionaires talk about it all the time? It really comes down to 3 powerful reasons that can help protect your wealth and help it grow over time. Number 1, it helps you manage risk. Different investments react differently to what's going on in the world. When the stock market is struggling, maybe because of inflation, interest rates, hikes, or global events, other assets like bonds, cash, or even certain types of real estate may go steady or go up. Think of it like this. If all of your investments are tied up in one outcome, that's one outcome that doesn't work. Your entire portfolio suffers. But when your money is spread out, one bad day in the market doesn't turn into a bad year for your finances. Diversification won't prevent losses completely. Nothing can. But it reduces how much damage a single event or your company can do to your overall success. Number 2, it gives you access to more growth opportunities. When you diversify, you're not putting all of your faith into just one company or one industry. Instead, you're opening the door to growth in lots of different places. Maybe tech stocks are booming this year, but next year energy, then healthcare or international markets take the lead. By investing across sectors and regions, you give yourself a better chance to benefit from what areas are growing without having to predict the future perfectly. It's like planting several types of seeds in your garden. Not all of them will bloom at the same time, but over the seasons, you'll see steady growth from different places. Number 3, you stick to a long-term strategy. Let's be honest. Markets can be emotional, but when things go up, we feel excited, everything's great. But when things go down, we panic and lose our stuff. A well-diversified portfolio helps smooth out those ups and downs. That means fewer dramatic swings in your account value, which makes it easier to stay calm and stay invested and avoid emotional decisions like pulling out at the worst times. Think of diversification like shock absorbers on a car.
Okay, get the procedure. Just got the light.
The bumpers in the road don't disappear, but the ride becomes smoother, more comfortable, and easier to stay on the course. So overall, diversification isn't about being fancy or overly cautious. It's about being smart. It helps you protect from your big mistakes, opens doors to new opportunities, and keeps your long-term plan on track. So now that we understand what diversification is and why it matters, Let's talk about how to actually do it. What does diversification look like in real life? Here's a few practical strategies you can start using. Number one, asset allocation. This is the foundation of diversification. It's about deciding what percentage your money should go into at different asset categories, like stocks, bonds, real estate, and cash. Stocks may offer higher growth over the long term, but come with more ups and downs. Bonds, on the other hand, are typically more stable and grow more slowly. Cash or cash equivalents, like savings or money market funds, offer liquidity but very little growth. Your mix should match your goals and risk tolerance and time horizon. For example, if you're young with decades before retirement, you might lean more towards the stocks. If you're closer to retirement, you may shift towards bonds and cash for stability. Number two, geographic diversification. Instead of putting all of your money into companies from one country, like US stocks, consider investing internationally as well. Different regions grow at different times. While one country's economy may be slowing down, another's may be booming. This helps reduce the risk of being too dependent on one country's economy, political changes, or current shifts. Think of it as not relying on just one engine to power your financial airplane. Number three, time diversification. Another practical strategy is investing consistently, no matter what the market is doing. This is called dollar cost averaging. Here's how it works. You invest the same amount of money at regular intervals, like every week or every month. When prices are high, your money buys fewer shares. When prices are low, the same amount buys more shares. Over time, this helps smooth out the cost in your investments and reduce the pressure of trying to time the market. Keep in mind that dollar cost averaging does not assure a profit or protect against loss in declining markets. These are tools to help manage risk, not promise of outcomes. Before you start applying all of these strategies, there's one key thing to understand. Diversification is not one size fits all. Your plan should be built around you. Here are a few important considerations. Personal factors matter. Time horizon. How long do you plan to invest before you need the money? Someone saving for retirement in 30 years is going to invest differently than someone saving for a house in 30 years. Risk tolerance. How comfortable are you with seeing your investments go up and down? Some people can't handle market swings. Others prefer more stability. Financial goals. Are you investing for retirement, college, savings, property, or just building general wealth? Each goal may require a different approach. Diversification still involves risk. Even if you're well diversified, your investments can still lose value, especially during broad market downturns. Diversification helps manage risks and does not eliminate it. And it's very important to remind ourselves, past performance is not guaranteed of future results. Just because something worked in the past doesn't mean it will work the same way in the future. Diversification isn't just an investing buzzword. It's one of those most important principles of building long-term financial stability. It's about creating balance. When you spread your investments across different assets, industries, and even countries, you're not trying to avoid risk entirely. You're learning how to manage it wisely. But here's the key. Everyone's financial journey is different. Your age, income, family needs, and future plans all play a role in what diversification should look like for you. That's why it's so important to have a plan that is tailored to your life, not someone else's. So take the time to review your own investments. Ask questions, and if you're unsure of where to start, talk with a qualified financial professional who can help apply these ideas to your personal situation. Because at the end of the day, diversification isn't about being perfect. It's about being prepared.